Today's training class will cover the easy money reports available through the Total Planning Suite. Total Planning Suite uses a single input and database to deliver two different planning approaches, and today we're going to be focusing on Easy Money, which provides a comprehensive needs analysis including retirement, insurance, education funding, and estate planning. Easy Money uses a conservative, goal-based planning approach. So once you have a client open and the scenario selected, you can generate either the Easy Money or Golden Years reports. When you do generate the reports, they're going to open up for you in a separate window. So I have my reports generated and open now. So today we're going to focus on these reports. I'm going to cover several of the reports available, but not all of them. As you'll notice, we have a total of 179 pages included, and that's because I've elected to run an entire set of reports. So every report possible is included in my projection. You can pick and choose the reports that are generated, so you'll want to narrow it down to the topics most important to your client. If you go back to the data input and report selection, Easy Money reports, this is where you can choose which reports are generated when you click on that Easy Money report button. So we have report sets that are predefined, or you can go into create modify custom reports and create your own list of reports that you'd like to have generated. So we'll move through the different sections. You can see what Easy Money primarily is concerned with. It has an investment section, retirement section, income tax, estate, and insurance section. So to start with the cover page, a couple of things I can point out here, where it says the report title, Personal Financial Analysis for Susan and David Example. These can both be set on the first data input available, so under Assumptions and Scenario Information. This is where it's going to pick up the client's names for the cover page report, so where it said Susan and David Example. Easy Money title, if you want to use something other than the default, you can type in your own title there and it will use that for the cover page rather than the default here of Personal Financial Analysis. You can also include your logo, and you can customize the advisor information, of course, and that's going to be back on the Assumptions, Data Input, the Report Options tab. So this 6 lines of cover page text is going to be where you're going to want to enter in your name and information about your planning practice. This information can be set up in the defaults as well. So under Tools and Settings and Defaults, you'll want to make sure the company information is entered there so you don't have to change it each time you create a new report. So it would be pre-populated for you. There's a few other items under Report Options, including the type of font that you would like to use for the reports, the heading color you would like to have displayed. Also report options such as including audit trail notes or having the program generate a table of contents and include page numbers on the reports. So you can see those options all under this Report Options tab. So in this case, under the cover section, I also have the table of contents as I've elected to have that table of contents created. The next section is going to be the general section, and this section provides a summary of the assumptions used for the analysis and a description and purpose of the reports. It's going to include a net worth statement, detail of the client's current assets, debts, insurance, and other items. It's also going to include a cash flow statement, liquidity analysis, and education funding reports. I'll be skipping the text pages, however, I do want to highlight this goal-based planning report. This is a great report to read. Golden Years also has the equivalent called cash flow planning, which I also recommend to read. It's great to read both of those report pages to get an understanding of the fundamental differences between Easy Money's goal-based planning approach and the optimized cash flow planning approach for Golden Years. So Easy Money uses goal-based planning, and it's going to be focusing on identifying the client's goals and determining if what they're doing now is enough to fulfill those goals. It's also going to use a more conservative or worst-case planning approach, and by that we mean that the pre-retirement period, the program is going to ignore their cash flow shortages or surpluses. So the program is only going to be saving what is scheduled as additions to their assets, not any surplus cash flow. The easiest way to explain this assumption is essentially just to look at if the client is not specifically saving the money by making a contribution to the asset, it's probably being spent. The program's also conservative when it comes to taxation. It uses the client's current marginal tax rate and assumes that their assets are fully turned over each year so that after-tax growth is reinvested. The objectives report is going to give you a summary of the client's needs or spending requirements related to the main goals essentially covered in easy money of retirement, survivor, education, or other financial goals. Objectives is followed up by the summary report, and this is going to provide a very brief overview of the client's ability to meet those planning goals or objectives listed on the previous page. Each of these objectives or goals and the client's ability to meet those goals is going to be explained in more detail later in the reports. The retirement summary is going to focus on the client's largest goal of retirement by listing the main assumptions for the retirement analysis, and it will also list at the bottom of the report shorted solutions in the situation where the client is projected to run out of money for their retirement situation. The next report is the net worth graph. This is, of course, going to illustrate the client's assets less liabilities to project their net worth. This graph is followed up by a more detailed numbers review, and that's the net worth statement. Multiple styles of the net worth statement are available. If you go back to the data input under assumptions and report options, you can see the different formats available. The consolidated format shows all the assets in a single column with a percentage of how much that asset makes up of their total net worth. The ownership style is going to break down the net worth by owner, so it's going to separate individual 1, 2, joint and community property, or trusts or other ownership. There's also a bank style view. This is going to lay out the assets on the left, the liabilities on the right, and it's a typical bank type format. And there's also an express style net worth. So now we get into some of those detailed report detailed report pages where it's going to list out the details of items entered in the program. So we start with asset details, A6. This is going to detail out all the investment assets for the client. I just want to point out a couple things on this report page. So one thing we get questions on here is this column where it shows the additions. So you'll notice there's a left side and a right side. And so anything to the left of the slash here is going to be any personal contributions the client is making to the assets. Anything to the right is going to be company additions. So if it's something like a retirement account where the client is making contribution and the company is also making contribution, you'll see the clients to the left and the companies to the right. The other thing I want to point out here is this retirement column. So you'll notice it says yes for almost all the assets here for the sample case we're looking at today. If this does not say yes, this means that there's a box unchecked on the asset input. So if we go back to the asset input here, you'll notice this checkbox, check if used for retirement. Typically you do want this box checked. If you uncheck this box, that means that this asset is only going to be picked up for the client's current year net worth statement. It's not going to be included in the retirement projections. Last thing about asset details is there is multiple ways to sort the assets that are listed here. By default, they're going to be sorted by description. So it's going to be alphabetical. If we again look back under assumptions and report options, you can see the different sort styles available. So we're going to skip the rest of these detail type pages, which are going to be listing all the details of things like personal properties, liabilities, insurance, and the like. Next, we get into the asset summary. This is going to divide the assets into 3 different categories by type, class, and liquidity. The most important category for the assets is type. That's how the program is going to track the assets and determine the account taxation for the retirement projection. So it's going to group all their taxable accounts, for example, together and project those going forward as one pot of money. Next, we get into the liquidity reports. So when you are entering a liquidity type for each asset on the asset input, it's used purely for the liquidity analysis pages, which is this A12 and A13 pages, which are just going to display the client's ability to liquidate their assets to cash. It's also going to include their liquidity ratios for total assets, which is including things like personal property and residences, versus working assets, which is purely investment type assets. If your clients want to learn more about the different liquidity types, they can get a full description of each one on the following report, which is A13. So once we move on from liquidity, we get into their current year cash flow situation. So first is the cash flow graph. This is going to provide you a summary of a graphical view, essentially, of what we can see on the following report, which is their current year cash flow statement. This is going to detail out all the income and expenses for the current year line by line. So you can see every income item and every expense that's going to be factored in by the program. Again, if there is a surplus here, the program is not going to reinvest it. You can see as part of their expenses any scheduled additions that they're making to the assets. The program is only going to save those specific contributions to the assets. So if they have a large surplus, you might want to ask them, hey, what are you doing with this money? If they indeed are saving it, then you can turn around and enter an addition to one of their assets in order to account for that being saved. So moving on to financial goals, there's a specific data input. If we look back at the data input here, for financial goals is used for one-time large expense items. You can choose whether you want the expense of these goals included in the projections or not with this checkbox. The advantage of entering items under financial goals versus other expenses, they work kind of the same way for the reports, but this will, if you enter them in the financial goals section, it will be included for this financial goals report, which is going to outline some funding options for the client. So it's going to determine how much they would need to save in order to meet those financial goals, either if they were to put a lump sum away today or make monthly deposits between now and the year of the goal. So the last section we have in the general category is the education funding reports. So like financial goals, if you've entered dependent children and education funding needs, the program's going to determine what needs to happen essentially to meet those education funding needs. So either a lump sum deposit today or level monthly deposits. The monthly deposits assume level payments between now and the last child's last year of college. So if they mark that they have any current funds available or monthly savings that they're making to these education funds, that's going to be factored into the solutions listed at the bottom of the report, A19 and A21. So those are good reports to focus on. Also, we have A22, which is education separate accounts. Rather than making the level payments from now through the last child's last year of college, this is going to evaluate each child's education need separately. And the last report here for education and the general section is education funding sources. This is a great report. It's going to show how the education costs are currently funded. So when it comes to the projection, if we look back at the education options here, if we have the box checked to include the expense in the calculations, that means that the program will first pull from the education funds available as indicated in this category. And then if any of the education funds are uncovered, it's going to be picked up as an expense and be pulled from the parent's assets. The investment section is going to discuss risks, financial attitudes, and asset allocation. So starting with this asset pyramid, this is going to list the traditionally safest types of assets at the bottom, and the risk is going to increase as you move towards the top. I do want to point out this option for retirement accounts, how you want them to be factored in for this section of reports. If we look back on the assumptions input under retirement assumptions, you'll see this checkbox include retirement plans and asset allocation mix, asset pyramid, and liquidity reports. If you want retirement accounts included for those pages, make sure you have this box checked, which we've done here, so you'll notice that it says retirement accounts are included in the groups above. If you want it kept out for these pages, make sure you have that box unchecked. Next, let's take a look at the asset allocation. The first thing to point out is that the asset classes and the suggested allocations are all fully customizable, so you can modify this to reflect the asset classes you use in your practice and the suggested allocations you use for your planning. The program is simply going to choose the client's suggested allocation based on the risk tolerance level selected. You can also choose to override that and enter your own suggestion if you go back to the asset summary input and the asset allocation tab. So if you enter in a suggested allocation here, it will use that rather than what you have set up for the defaults. The next page is just a graphical view of how the clients are currently allocated and then the suggested allocation. This is followed up by a more numbers view, which is going to show how the clients would need to rebalance in order to achieve that suggested asset allocation. The next item we have in this is stock options. So if you have any stock options entered, the program is going to display these stock option reports, and it's going to capture the tax and cash effects of exercising and selling the stock options. So you can see all the details of these options if you go to report B10. And the last item in the investment section, again, if you have rental real estate entered, you'll get these rental real estate reports. They're going to provide a summary of all the real estate properties entered in the rental real estate section, and it's going to detail out the income, the taxes, the expenses associated with each of those properties each year. Now we're getting into the retirement section. So this is kind of the heart of the reports for Easy Money, as retirement is typically the ultimate goal for your clients. So this section is going to focus on if the clients are going to have adequate income and capital to fund their retirement goals. So let's take a look at the retirement capital graph. The first graph is actually showing their annual expenses over time, including inflation. There's also a yellow line available that you can see here. This shows the expenses in today's dollars. The second graph at the bottom here is the total capital available, and this is the graphical view of the client's total assets over time. If they run out of money, you'll see a shortage display in red. This report is going to be followed up by the details report, which isn't directly after, but it's available on the retirement capital estimate, which is C6. So this is a graphical view of that retirement capital estimate page, which we'll get to in just a moment here. But first, we're going to look at the retirement needs analysis. So the retirement needs analysis is going to display the client's total income needed to cover their expenses from retirement to life expectancy, and it's going to compare that to the total income streams available from retirement to life expectancy, which help offset the spending need. So total expenses less income derive the income shortfall. This is the amount that the clients are going to be spending. This is essentially the amount of spending that will exceed their income sources from items like pension and Social Security. The last line of this report is the estimated capital required at retirement to satisfy the shortfall. So assuming a typical situation where the client would be spending more than they have coming in from outside income sources, they would have a shortfall. And the program is going to determine the amount of assets that the client would need to have saved by retirement in order to cover their future income shortfalls. This report moves directly into the following page, which is the retirement capital analysis. That's going to actually consider the amount of assets that the clients are projected to have by the time they retire. So if we move on to the retirement capital analysis, this report is going to carry over that client's total income shortfall and the capital required to cover that shortfall from the previous page, the retirement needs analysis. Next, it's going to list the client's assets and their projected balance at retirement. If the client's total asset values exceed the capital required, then the program essentially has determined that the client has saved enough to cover their future cash flow shortages, and they're not projected to run out of money prior to life expectancy, so they're on track for a successful retirement. If the client's assets values at retirement do not meet or exceed that capital required, then the clients are going to have a shortfall and they're going to deplete their assets prior to their life expectancy. If it is a situation for a shortfall, the program is going to display shortage solutions, and those shortage solutions are going to include achieving a higher rate of return on investments, increasing their saving, which solves for monthly additions required at 3 different rates of return. It's also going to look at the ability to delay retirement age as well as reduce spending. So if we look at this retirement estimate solution, C5, this report will really only be of use if the clients are running a shortage. If they are, this is going to project how the client's shortage would be fulfilled if they were to either increase their overall rate of return or make those deposits at the 3 different rates of return. So now we get into the retirement capital estimate. This is really the heart of the retirement reports. This shows the year-by-year summary of the client's total expenses and scheduled income sources. Any surplus that you see listed here on the annual surplus or shortage column will be automatically reinvested, and any shortage you see here will be pulled from the investment. So unlike pre-retirement cash flow, where shortages and surpluses are ignored, anything that shows up on this report, if it's a shortage, it will be pulled from the assets, or if it's a surplus, reinvested. So this is a good report to make sure that the shortages and surpluses are what you're expecting. So the resulting asset balance will display in the last column, so you can see how their asset balance changes year by year. And let's see here, if that total account value no longer shows a value, that means that the clients have depleted their assets, so the retirement capital has been depleted. This is also a great place to talk about using the audit trail. So if you have the audit trail notes turned on, which again, you can turn those on or off if you go back to the Assumptions and Report Options tab. Take a look here, and here you can turn this on or off. But I do recommend having it turned on, especially as you're exploring the reports and breaking down the numbers. But you can see the little audit trail references. For example, if we had a question on the expenses, we could take a look at the audit trail reference. It will tell us which report page to go view to get a more detailed breakdown. So in this case, the detail behind the expenses is in the appendix section. So we'll open up the appendix section, go to the report page referenced, and you can see how that's broken down. So you can see all the details that make up that total expense number. And if anything can be broken down further, you'll notice it will also have an audit trail reference on the bottom right. So you'll notice all the reports are numbered on the left-hand side. So each category has their own number. Their own letter followed by a number. So the investment section are the B's, the retirement section is the C's, and so on. So this is a great report to really focus on. It is also followed up by the asset accounts. So this is going to give you more information about how the account balances are changing for each type of asset over the lifetime of the projection. This again, we could take a look at the supporting type details. So if we want to see exactly how the taxable account, for example, was changing year by year, we could take a look at the appendix section. It's referencing report H1, and we can see all the elements that are factored in for how that taxable account balance is changing year by year. Going back up to this retirement section, if we look at total asset accounts, this is going to display the total asset account balances over time and how the balances change with things like additions, withdrawals, taxes, and the rates of return. Next, we get into the retirement Monte Carlo simulation. So you'll notice here the graph, we've got the blue line. The blue line is going to be the fixed results. So the projection that we saw in C6, so the results given the fixed rates of return that we've entered into the system. The gray lines that you see here are going to represent a sampling of the 10,000 trials that are run using the random rates of return. And if we look below the graph in little font here, we can zoom in a little bit, but you'll see the standard deviation that's used, and it will show you that it will show you what 95% of the rates will fall between, so the first two standard deviations here. And the program will go out a total of 5 standard deviations. You can also choose to have the fat tail option included, which is going to add more emphasis to those extreme negative market events. So looking at the numbers at the top here, the original retirement capital estimate, that's how much they're projected to end up with on that blue line, or the same numbers we would see on the retirement capital estimate, assuming that fixed rate of return that we've entered in the system each year going forward. The minimum worst case essentially is going to be the worst case of those 10,000 trials that are run. The average is going to be the average of those 10,000 trials, and the maximum would be the top results of those 10,000 simulations that are run. When we look at the percentages on the right-hand side, the percentages of results above 0, that would be of those 10,000 trials, how many of these trials did not run out of money, so they never hit 0. You can also see that there's that percentage available for 3 different ages as well, so you can see how their overall situation is changing throughout the years. So the last section, the last reports of this section are the withdrawal rate pages. They're going to compare the total funds available to the withdrawals that the client's making for their shortages to determine the net withdrawal rate each year. There's a moving average graph as well. This is going to show the average withdrawal rates over the periods of annual, 3-year, 5-year, and 10 years. The income tax section is going to analyze the client's taxable income sources, exemptions, deductions, and provide a projection of the client's current federal and state taxes. Easy Money provides a detailed tax calculation for the current year. After that, going forward, Easy Money is going to estimate the taxes using the client's marginal tax rate and applying that to the taxable income sources. This tax rate can be overridden, so by default it's using that current year tax rate. If you go back to the data input under income taxes, we can take a look here under the filing status options tab. You can see the optional tax rate, Easy Money only. You can choose to use a different tax rate for the pre and post retirement period. So if we take a look at this income tax graph, this is going to display the client's after-tax income in green compared to the total taxes in red. This is going to give you a summary of the client's taxable income and display total taxes. That's going to be listed in more detail on the next report page. This is an easy place to see the client's marginal tax rate that's going to be used for the projections. So if we look at income taxes, this is going to give us more detail here. It's going to calculate the amount of income taxes expected based on the client's income and asset information provided. You can see the line-by-line breakdown of everything that's going to make up their income sources, any adjustments and deductions and exemptions to arrive at the total taxable income. And this is going to break down the total taxes due into federal taxes, any payroll taxes, A&T, state, and other taxes. The next report page, income taxes paid, this is the report that's going to show a summary of the income taxes paid on the various income sources every year going forward. So that's essentially going to be using that estimated tax calculation using the client's current marginal tax rate. Next we have the estate section. And so this is going to list their current estate situation as well as an alternative or suggested estate situation. If we take a look at the estate details, this is going to list the assumptions used for the estate planning reports and any estate planning documents that the clients already have in place. This also includes a net worth statement, a more summarized net worth statement. The estate graphs, this is going to display two graphs. The first is if individual 1 were to die first, and the second is if individual 2 were to die first. So each of these graphs illustrates the individual's net taxable estate, estate tax, and any estate tax if they were to use a credit shelter trust and an ILET. So the bottom of this report, there's an illustration of the actual dollar amounts that appear on the reports. This graph represents the calculations that are included from the next report, which is the estate tax illustration. So we can get into the details and the numbers behind the graphs on the following page. So the estate tax illustration is going to show the calculation of estate taxes assuming current deaths of individual 1 followed by individual 2. So essentially it's going to run the calculation if individual 1 were to die first followed by individual 2, and then also the reverse if individual 2 were to die first followed by individual 1. This report is going to use the current year estate tax laws to calculate the estate taxes due. For married couples, it's going to assume that no estate taxes are incurred during the first death, all the assets are transferred through marital transfer, and then the program is going to run the scenario without trust assumption, and then it will also show the estate situation with trust situation, which is going to assume the clients are funding a credit shelter trust and move any insurance into an ILET. So the next report, estate chart, this is going to illustrate the without trust situation from E4. So that's going to represent the client's current estate situation. The next report, the with trust, a chart would essentially illustrate what we saw in E4, assuming that the clients are using a credit shelter trust and any insurance into an ILET. There's also future estate reports as well. And so the program is going to look at the client's taxable estate and potential estate taxes at any point in the future, essentially. So rather than the current year like the previous pages, this would evaluate their estate tax situation each year of the projection. There's several educational type reports or illustrative type reports in this section. So you can see E9 through E20 essentially are going to illustrate different estate planning concepts. The last section of the estate reports are the estate planning options. These allow you to specifically look at an age of death that you have entered in the program. If you go to the estate input, you'll notice an estate values tab, and this top section where you can enter in an illustration age of death, this is going to use purely for this estate planning options tab, so you can evaluate a specific age of death, and you can illustrate gifting based on the items that you've entered in that estate values tab. So now we're moving into the insurance section. This is the last of those main sections covered in Easy Money. The insurance section is going to provide details regarding the need for insurance projection if death were to occur now or at any point in the future. This section is also going to include a discussion of disability, property casualty, and long-term care insurance. So we'll start by looking at this life insurance graph. This graph's really nice. I love this one. It's going to display the total capital needed versus available for the survivor situation. So any gap between the yellow line, which is the capital needed, and the green bars, which are the capital available, means that the survivor would have a shortfall situation that could be filled with life insurance. This is a great graph to show how life insurance needs might change over time. If there's only a gap in the first 5 years, for example, a term policy might be best for the client. The numbers to support the graph are included on the following pages, F3 and F4 for if individual 1 were to die and individual 2 were to be the survivor, which is the top graph, or F5 and F6, which is the opposite situation if individual 2 were to die and individual 1 were the survivor. So let's take a look at that next report, which is the survivor needs for individual 1. This is going to work just like the retirement needs analysis pages, where it's going to look at the total amount needed versus available for survivor situation. So if we look here, we can see the total amount of life insurance needed if individual 1 were to die at their current age, or 10 years before life expectancy, and 2 midpoint ages. So essentially we're going to evaluate 4 different ages for life insurance needs here. This report is going to compare the total spending needed to the total income sources available to come up with the capital required to fund the income needed. This number represents how much the survivor would need in assets today to cover their future shortfalls. The program is going to add in any immediate cash needs to that capital required to come up with the total capital needed at individual 1's death. This total capital number is then compared to the total assets available and any insurance coverage currently available. So if that total capital needed exceeds the total assets plus any insurance coverage currently available, that means that the program is essentially going to list the difference as is suggested for additional life insurance coverage. So this is going to be illustrated at every age on report F4. So if we jump down to F4, we can see here this report creates a worksheet essentially describing the income needs and sources on a year-by-year basis. So it's also going to detail that capital needed for income, immediate cash needs, net assets, and total life insurance needed. The big number here, the number to understand, is that capital needed for income. That capital needed for income is the amount of capital that they would need to satisfy all remaining years of shortages and surpluses if death were to occur at that point in the projection. For example, if we look at the capital needed for income listed for age 70, that's the amount that they would essentially need, that would be the amount required to meet all the future shortages and surpluses from age 70 through life expectancy. So that number is calculated just by taking the net present value of the shortages and surpluses that occur from that age until the client's life expectancy. So we can see we have the same reports for if individual 2 were to die and individual 1 were the survivor. So you can evaluate that life insurance for every year of the projection. Next, we get into disability. So we have a disability graph, and that's going to look at comparing their expenses to the income sources available for a disability situation on either a short-term or long-term basis. And you can get more details on the next report here. And this is going to break down the total income needed for living expenses compared to income sources for, again, the short-term or long-term disability situation. And you'll notice here the the disabled individual's earned income no longer appears, but the non-disabled income is available along with any current disability benefits. So then if we take a look here, F9 through F12 are mainly just text reports. So you can read those at any time, but I do want to take a look at report F11, which is a long-term care report. This is a long-term care needs analysis, which is going to show an estimated total cost for long-term care for individual 1 or 2. And you can set that total cost of long-term care and the number of months of care for this projection if you go back to the insurance input and that disability and long-term care tab. This is also where you can enter in any disability benefits used for that disability report on F8. So that really takes us through all the sections available in Easy Money. You'll notice the next section is the Appendix section. We're not going to go through this section today, as you've seen a few pages when we were using the audit trail. Mainly this section is here to support to provide supporting details and essentially help you break apart those more summarized values used for the main projection. So a lot of supporting pages here, and again, using that audit trail, you'll notice a lot of times it will take you down to this appendix section so you can break down the numbers and get to the values that you need. So I think that's everything that I wanted to cover for today's Easy Money class, and thank you very much for taking the time to join us.